A war breaks out, oil jumps, fear spreads across every screen, and the one asset people call a shield suddenly drops like a stone. That is the kind of move that makes normal people feel cheated because it looks backward, almost insulting. If gold is supposed to help when the world gets dangerous, why does it sometimes fall exactly when the danger gets real? That question matters more than the drop itself because the wrong answer pushes people into the worst kind of decision, a fast emotional one. And when money is moving on fear, speed, and confusion, a bad reaction can do more damage than the event that scared you in the first place. If you like videos that pull the mask off market chaos and show the machinery underneath, stay close because this one only gets more important the deeper we go. Most people carry a cartoon version of gold in their head. The cartoon says gold rises when headlines get ugly, falls when life feels calm, and acts like a simple panic button you press during global stress. That story is easy to remember, which is exactly why it fools so many people. Markets are not moved by simple stories for very long. They are moved by pressure, incentives, forced choices, and the plumbing hidden behind the headlines. When people say gold is a safe haven, they usually mean one thing. It holds value when trust in other things starts to crack. That part is still true. The problem is that people confuse a long-term role with a short-term reaction. A life jacket can save you in the ocean, but if a wave hits at the wrong second, you still go underwater before you rise again. Gold can play defense over time and still get shoved down hard in the middle of a violent move, especially when the rest of the financial system suddenly starts offering a better immediate deal. So forget the explosions for a second and look at the chain reaction they can set off. War pushes energy higher. Higher energy pushes inflation fears higher. Inflation means central banks get nervous about cutting interest rates too soon. When interest rates stay high, bond yields rise. A bond yield is the return you get for lending money to the government. And when those yields climb, gold has to compete with something it hates competing with, safe income that actually pays you while you wait. That is the part most people miss. Gold does not send you a check. It does not pay interest. It does not produce cash flow. Its strength is different. It sits outside the promise-making machine. It is no one's liability, no one's IOU, no one's delayed payment. But when government bonds suddenly offer a strong return, many investors stop asking what protects me in 10 years and start asking what pays me this quarter. And if you want more videos that turn complicated money moves into plain English before the crowd catches up, you already know what button deserves your attention. Think of it like this. Imagine two boxes on a table. One box is gold, quiet, solid, patient. The other box is a government bond paying more than 4%. In calm times, people may prefer the quiet box because it protects against currency weakness, inflation, and policy mistakes over time. But when fear of inflation rises and bond yields jump, the second box suddenly looks less boring. It starts paying rent while the first one just sits there. Now add the dollar on top of that. When global stress hits, money often rushes into the US dollar because people still see it as the deepest cash market on earth. A stronger dollar makes gold more expensive for buyers using other currencies, so demand can weaken at the same time yields are already making gold look less attractive. That is how you get the strange moment that confuses almost everyone. Fear rises, but the dollar and yields rise even faster, and gold gets squeezed in between them. But a slow squeeze is not the same as a sharp collapse. To understand the violence of the move, you have to look at leverage. Leverage means borrowed exposure. It lets people control more than they could normally afford. That feels brilliant on the way up because gains arrive faster, but it becomes brutal on the way down because the position starts managing you instead of the other way around. The same tool that made people feel smart during the rally can turn into a trap door once the price starts slipping. A lot of investors do not own plain gold. They own versions designed to amplify each daily move. Those products reset constantly, and that design matters. When the underlying asset falls, the fund may have to sell more just to maintain its structure. That means the decline creates fresh selling, and the fresh selling creates a deeper decline. It becomes a loop, not because everyone suddenly stopped believing in gold, but because the product they bought was built to dump exposure into weakness. That is why some drops feel so much uglier than the headline explanation. What looks like a broad vote against gold can actually be a mechanical flushing of fragile positions. Weak hands are not always weak people. Sometimes they are just holding instruments that give them no room to breathe when volatility spikes. If you have ever wondered why a market move feels too violent to be explained by news alone, that question is worth following, because it shows you where the forced sellers are hiding. And while that paper selling is happening, something very different can be happening in the real world. The screen price you see every second is mostly the paper market. That means futures, funds, contracts, and fast-moving money. The physical market is different. That is bars, coins, central bank reserves, vault transfers, jewelry demand, and long-term buyers who are not reacting minute by minute. Those two worlds talk to each other, but they do not always agree, especially during a panic. This is where the picture gets interesting. A paper sell-off can look like a total rejection, while physical demand stays stubborn, even calm. In simple language, traders may be dumping claims while buyers keep taking actual metal. That matters because it can signal a transfer instead of a collapse, a handoff from fast money that needs immediate relief to patient money that is willing to wait. The loud part of the market says one thing. The quiet part keeps accumulating, and the quiet part often matters more than people realize. History gives us clues here, but not in the way most people think. People love dramatic explanations. They want one villain, one headline, one clean reason. Markets rarely give you that gift. There have been periods before when oil-producing countries faced cash pressure, reserve pressure, or shipment problems and had to raise dollars fast. When that happens, even assets built for protection can get sold because cash flow problems do not care about your long-term investment thesis. That is a hard lesson, but an important one. In a stress event, some players are not asking, is this asset undervalued or will it protect me over 5 years? They are asking, what can I sell by Friday? Governments defending currencies, funds meeting margin calls, firms covering short-term gaps, and traders trapped in leveraged products all behave differently from patient savers. A market can fall for reasons that have almost nothing to do with whether the deeper case is alive or dead. And then the machines join in. A huge amount of modern trading is not a human sitting at a desk thinking about history, war, or long-term monetary trust. It is code responding to conditions. If the dollar jumps through a level, if bond yields push above a threshold, if volatility expands, many systems hit the sell button automatically. The algorithm does not ask whether bombs are falling. It does not care who is scared. It only reads inputs and follows instructions. That is why a move can feel so cold. People are searching for meaning while the machine is simply running. A manager gets on television and tells a story after the fact, but the trade may already be done. By the time retail investors hear the explanation, the forced selling, the trend models, and the risk systems have already done most of the damage. If you want this channel to keep translating machine-driven chaos into human language, ask yourself one thing. How many market moves have looked random until you saw the hidden trigger? So now we have two clocks running at once. The first clock is short-term. It is driven by yields, the dollar, leverage positions, and systematic selling. That clock can be cruel, fast, and deeply misleading. The second clock is long-term. It is driven by debt, trust in currency systems, central bank behavior, and whether governments can live with the interest burden they have created. If you mix those clocks together, you will almost always misread what gold is doing. The long clock matters because the world is drowning in debt. When a government owes an enormous amount of money, higher rates do not just cool the economy. They also make the debt itself more expensive to carry. Refinancing means old debt has to be replaced with new debt, often at current interest rates. If current rates are much higher, the bill gets ugly fast. That is where the quiet pressure builds because a system loaded with debt cannot enjoy high rates forever, even if it pretends it can for a while. This is why gold still matters even after a nasty drop, not because it rises every time fear appears on television, not because it is magic, not because it wins every month. It matters because it sits outside the chain of promises. Stocks depend on earnings, bonds depend on repayment, bank deposits depend on the banking system, gold depends on none of those. It does not promise anything. That sounds boring until the world gets unstable and people remember how much of modern finance is built on trust. And that trust issue is bigger than many people think. Around the world, central banks have been adding to their gold reserves over recent years, not because they are nostalgic, but because they understand strategic insurance. They see sanctions, payment risk, currency friction, geopolitical fragmentation, and the growing possibility that global trade becomes less smooth and less friendly. When institutions that think in decades keep buying while the paper market is panicking, that contrast deserves more respect than a daily candle on a chart. This is also where investor psychology does its usual damage. Most people can survive a loss in money more easily than they can survive a loss in certainty. What breaks them is not only the drawdown, it is the confusion. They bought something for protection, then watched it fall during danger, and suddenly the whole thesis feels like a lie. So they do what humans do under pressure. They turn one painful moment into a permanent conclusion. But one ugly move does not automatically mean the case is dead. Sometimes it means the market is clearing out borrowed conviction, overpriced momentum, and crowded assumptions before it can breathe again. That does not make the pain fake. It just means pain and meaning are not always the same thing. A burning kitchen alarm does not always mean the whole house is gone. Sometimes it means the system is noisy because something hot hit the pan. If you want a simple framework, watch three things instead of one. Watch yields, because higher yields raise the cost of sitting in gold. Watch the dollar, because a rising dollar can pressure demand worldwide. And watch whether physical demand is cracking or holding, because that tells you if the move is broad abandonment or mostly a paper market event. One chart can scare you. Three signals can calm you down enough to think. Now raise the stakes a little further. If high rates stay too high for too long, the debt burden gets heavier, growth slows, credit strains, and eventually policymakers face a nasty choice. They can defend the currency with tight policy and squeeze the system, or they can ease, print, cap yields, or find some softer name for financial relief. And the moment that policy mood turns, the same forces that pushed gold down can reverse much faster than people expect. That reversal matters because markets do not ring a polite bell when the pressure changes. A falling yield means the bond alternative becomes less exciting. A softer dollar makes gold easier to buy globally. Exhausted selling means fewer weak positions left to flush out. And once the mechanical headwind eases, the asset people mocked last month can suddenly look obvious again. By then, the crowd that sold for emotional relief usually has to buy back for emotional regret. That is why the biggest mistake is often not buying too early. It is misunderstanding what kind of move you're looking at. If you treat a mechanical unwind like a funeral, you hand your position to someone calmer than you. If you assume every drop is proof of failure, you become the perfect exit liquidity for stronger hands with a longer clock. And if you want this channel to keep building that longer clock in your mind, maybe the better question is not should I follow, but what happens if I keep trying to read long cycles with short emotions? None of this means gold only goes up. It does not. None of this means every dip is a gift. It is not. And none of this means you should ignore risk, timing, or your own financial reality. What it does mean is that price can tell two different stories at once. One about immediate pressure, one about structural value. People get hurt when they assume those stories are always identical. In stress events, they can drift far apart for a while. So when you see gold falling during war, Do not jump straight to the easiest conclusion. Maybe the market is not rejecting protection. Maybe it is pricing tighter money, stronger yields, forced liquidations, reserve stress, and machine-led selling all at the same time. Maybe the contradiction is not proof that gold failed. Maybe it is proof that most people were watching the wrong drivers. Because in markets, the thing that looks broken on the surface is often just getting repriced by forces no headline bothered to explain. And that is the deeper lesson underneath all of this. Gold is not a panic toy. It is not a one-button trade for scary news. It is a mirror held up to confidence itself. When trust in paper promises stretches too far, gold matters. When yields rise and cash pays, gold can struggle. When both forces collide, the path gets messy. The crowd sees a contradiction. Patient money sees a sequence. So the next time fear spikes and gold does something that looks wrong, ask a better question. Not, why isn't my safe haven acting safe? Ask, which clock is speaking right now, and who is being forced to sell before the long game even starts? That question can save you a lot more than gold ever will.